What is going on? Welcome back to the MG YouTube channel. I'm Malachi, Greb, CEO of Elite Automation, Elite Properties, and an investor in Tesla. So actually, I just did the earnings video yesterday for Q2 of Tesla, and I started rambling about some of the property things that we have going on. And so, I went and just kind of cut that video and wanted to start a new video and post it out on a different day, so I wasn't rambling on a different topic. So for those of you who don't already know, basically we own three companies, and then I also invest in Tesla. The one company I just never really mentioned, we do like automotive rentals, which is kind of actually a business that we're like shutting down. And then we have Elite Properties, which is basically we're doing property investment, right? Long-term hold stuff, really trying to build equity. Some of the things that we're buying are like rent ready, and then we're also buying some that are like need complete renovations. We bought a house for like $30,000, and then we flipped it into like a $180,000 property. Again, holding on to the property, but we cashed out refied on that property. Let me know down in the comments below if there's any particular angle or questions that you have, because I don't know exactly how I'm going to go about structuring these videos and how I'm going to lay this information out as far as like some of the other business things that we're have going on, like the properties and stuff like that. But like as I mentioned in the last video that I just cut off, was like, as of right now, we have a target to acquire 3 properties in 2 months, and so this business is still really young for us. As of right now, we actually only currently have 3 properties. And so for us to go from 3 properties to like 3 this year is a significant jump. We're going to 2x what we're doing. And really, it's kind of been, basically at first, it was like just my initial personal properties that got converted over to, rentals and stuff. So I bought one property, lived in it for like 5 years, rented it out, moved into another property for like another 7 years, moved out, rented that property out, actually got an apartment in between until we kind of like figured out exactly what we wanted to do, and then bought another property roughly like 1 year ago, a little bit over 1 year ago, like 1 year 1 month, which is the property that we currently reside in. And then what was it, like, I guess it's been like 6-7 months, we bought basically our first like major like flip. And so we went through and we bought the house for like, I think $35,000, put like $40K into it, and then was able to cash out refi on that property for like $180. So cash wise, we pulled out like $90K. However, the valuation of the property was like $180. So, all in, we were like in $75,000, and we have now an asset worth $180,000. So we also whenever it comes to flipping, the first, second, all the properties, we went in and renovated them. So like whenever I long-term rented them, I didn't initially do like a ton of work, and then it was like a year later, and then we went through and did like kind of a full flip on it, redid the floors, carpet, paint, all these things. And then the other one, while we were still living in that second property, like that last 6 months of living there, we went through and renovated a bunch of the things. We added a bathroom to it, we added a bedroom to it, redid all the floors and carpet and everything in that property. And then we had the third renovation property, where that one was a pure like buy it and flip it type of deal, like buying it in like super bad condition. Obviously, if you're buying a house for $35,000, it was a pretty bad condition. Basically, had to redo every single thing in the house. I think the only thing we was able to keep in that house was like a bathtub and the kitchen cabinets and countertops. We was able to keep that. But yeah, so now we have the target for like in the next 2 months, we're going to close on three houses. And as of right now, we're doing like very like kind of low end houses. Why? Because we want to scale on the number of houses that we have at this very moment. Because we're at a very interesting time, and this is something that's very, very valuable. Is in the very beginning of investing, your dollars are much more important in what you do with those dollars. They're always important on what you do with those dollars, but it's extremely important in the very beginning. Why? It's because your ROI, your return on your money, might be too long out. So like if I invest in something and like let's say for a property and I long-term rent it out, it may take, if you say for instance make a bad investment, it might take 5 years to get your money back. So unless you have some other source where you can continually dump money in, you're not going to grow anything. You're going to be like 60 by the time you have like 5 properties. But it's like, say for instance, if you are something like an engineer, right, and you have a good salary and like you're able to be very frugal with what you do, and you can take half your salary and make that deploy that towards like down payments and closing costs and all that on a property, so that way like every 1 year you can buy a new property. Now you have scaling. Now it's outside scaling, which is something that's a little bit different than what I'm trying to do with elite properties. 1 second, I think this wind's blowing too much. Which is something that I'm trying to do with elite properties is allow elite properties to grow without extra interjection of money. Now, the flip side to that is how I'm wish-washing money between like property investments and like stock market investments. I will take gains off of like some big short-term jumps in stock market gains and put that back into properties. And then property cash flow, I let property cash flow just stay in the properties, in the properties company. However, if we do like a cash out refi, aka we buy a property, we do something to it, and then we pull the money back out of it, that money I will take and wish wash. When I just cashed out on my personal property, which is one of the things I'm going to do, I'm going to take that and put that in the stock market. It's personally owned property, so technically that will never even go into elite elite properties. That'll just go directly from me as a person to the stock account. Now, if I make any significant gain over the next 3 months or something like that, then I'll take some of that money, pull it out, and put it into properties. Actually, the money that I'm pulling out now is already basically earmarked for properties. So I'm pulling the money out of this property. That money is actually going to be deployed towards some of these 3 properties that we're currently buying. However, in the meantime, I'm going to set it in the stock market because, the way I look at it is, especially with something like Tesla, I have the confidence that, yes, it can go down, but with the current stock price that it's at now, I feel much more confident that we're going to have a significant upside than we are to have a major downside from where we're currently sitting at. So, like, with that being said, I don't try to short-term trade stocks. However, I look at the stock market somewhat as a bank account to hold money in that just happens to fluctuate a lot in a day, right? And so, like, if I got to pull money out today and things are down, I pull money out and things are down. If I got to pull money out today and things are up, great, things are up. If things stayed the same, then things stayed the same. And so that's just kind of my philosophy. Now, like, let's say for instance, 6 months from now, Tesla does shoot up to $500 a share. Okay. I then at that point won't hold as much money in Tesla. So what I'll do is I'll then diversify, right? I'll have more money in AMD at that moment. I'll look at whatever stocks that I have, like basically in my watch list, and I'll say, which one do I not have adequate money deployed to? Okay. AKA, just basically re-diversify my portfolio. I like to look at like what what should have an upside but that doesn't have the upside yet. So for example, I made a bunch of money off AMD. And actually, I made a short-term mistake, because I made some money off AMD. I had a pretty good position there. I took some of that money and I moved it over to Tesla, and AMD happened to go up way more than Tesla. But I thought Tesla, with launching the Robotaxi and stuff like that, we would have already seen a major upside, and I wanted to make sure I had as much capital in Tesla as possible whenever that upside occurred. So with that being said, like, the option contracts that I was holding for AMD, like, 7x'd. I mean, it would have been wild if I'd have just stayed there in that position. But with that being said, like, something like that, I would have redeployed that money towards, properties or something like that. If it would have 7x'd overnight, I would have immediately cashed out probably at least half of it. I would have probably took another half of it and deployed it towards some other stock that I feel like just didn't have that upside gain already, and I would probably take that 350 that 350 cash, and I would take it and probably just invest it into properties. Why properties? Because properties cash flow, and so, like, that's the biggest thing that I'm buying with properties right now is one, they have the ability for you to keep re-rolling your money, and I'll mention that here in a second. And the other thing is they cash flow. Meaning, like, stocks, unless you have dividends, they don't cash flow. They don't bring you any money every single month. Going back into re-rolling your money, this goes back to the thing about it being a good investment, right? If you re-roll your money, aka I'm going to go back to the same example. I bought this house for $35,000. I put $40,000 in it. It's now worth $180,000. I pulled out $90,000. So now I have $15,000 in the positive in my hand that I would not have had. And I got my initial investment back. That itself is so important. I pulled back every dollar that I put into that property and now have it back in my hand again 6 months later. Like, literally 6 months on the dot. We were done with the renovations and everything 2 months before we could even cash out refi on it. So, which is another thing, actually. You have to wait 6 months to cash out refi on the property after you buy it. It has to go into your name, and you have to wait 6 months. That's just like a little nugget of gold that's very important, because I found that one out, the hard way. But it wasn't a big deal for us. It wasn't like a critical thing. We just had to wait like an extra month or so to get the money. So now I re-rolled that cash. That's why I like talking about re-rolling the cash. Now I re-rolled that cash, and I put it back in the stock market. We had some good gains off of that stock market money. And so, that's another reason why we're deploying more capital towards towards properties, right? And again, it's the cash flow side of things. One of our main targets that we have as a company, or as Elite Properties has as a company, is we want to be able to basically be able to buy a property every 3 months. So that gives us a target that we need to we want to buy a $300,000 property every 3 months, which just basically gives us a target that we need to have $20,000 in profit per month for 3 months. And also, too, like, when you calculate it in closing and stuff like that, like, really we need like closer to like $25,000 a month in profit to be able to hit that target. So that target, honestly, it's likely to be a few years out. It depends on how much we re-roll, aka are able to just cash out refi the money, versus just buying a property that doesn't really have any major upside in equity. So again, I like to buy properties that have major upside in equity, because we can re-roll. If you buy a property and it's already at value and you can't really do any renovations or anything like that to increase its value, then you're kind of stuck at that valuation level, meaning you can't then cash out refi. They're not going to allow you to cash out refi unless you could say the property's worth X amount more. So, like, for example, for some numbers' sake, if I bought a property for $100,000, I had to put $20,000 down Also, with closing costs and everything like that, you're probably going to be closer to $30,000 total cash that you have to take out of your pocket. Oh, and so you have $30,000 cash out of pocket. You're gonna need that property to go up to like $150,000 or something like that. Because also when you cash out refi, you have to spend like another $7,000. So that to cash out refi for the closing of that. So that's gonna cost you. So now you're basically, I'm just use rough, clean numbers. That's gonna take you up to $40,000. So now you have to compensate for $40,000 worth of cash. So you're gonna need to see at least, a $40,000 upside, aka that property needs to go up to like $150,000, $180,000 of worth in order for you to be able to cash out your cash. So like that's something you definitely have to keep in mind. Like the re-rolling is super important. One thing we're really trying to do with these 3 deals is we're actually trying to do 2 that are completely ready and 1 that needs a rehab. So, basically 2 of them, we're just gonna our cash is gonna be gone, but we're gonna be able to cash flow immediately. Then the other one we'll have like 6 months to get it ready and do all the things to it and all that good stuff, and then be able to cash out refi on that to then have this money in hand to put into another next property. And on top of that, like with these 3 properties, this is actually going to get us cash flow wise probably to a point where we're capable of doing a property like every 5 months or something like that. So it's getting us close to our target goal of the 3 months. So I'll do quick math. So we've already done the math of like, we think we'll do like 9,000 more revenue, 6,000 more profit, and we'll so if you do the math on like 10 months, that's $60,000, which is like double what we need. So yeah, I mean, cash flow wise, I think it's going to work out pretty well. We'll be at that. We'll be at like the 5-month mark, and we're trying to get down to 3-month mark. So I think literally within like 1 more year, if that, we should be at that target of being able to get a property every 3 months. And then when you start getting down to like the 3-month mark, or you start to get even lower to the 1 month mark or half a month mark, if you can afford a property every month, every half a month, now you start getting into other bottlenecks in business as far as like finding the properties fast enough, closing on them fast enough. At that point, if you're really cash flowing that heavy, like it almost makes sense that like you go to close on a property, and then instead of putting 20% down, you just go ahead and put like 40% down, because you're not even able to buy properties fast enough, so your cash is just stacking. So instead of like letting your cash continue to stack too much, just go ahead and either put a huge down payment on your property, so that way like it just decreases how much you got to pay in a month. Or the other thing that I've been calculating out is just buy the property cash, because that saves you a lot of money in the financing. It saves you a lot of money in the closing. Financing, as far as like at closing, you have to pay an amount for financing. Like I was saying, like closing is, could cost like $7,500. It's very variable. So, but like say for instance, that same $7,500 at closing could cost $3,500 instead if you just close it as a cashed out property. AKA you own it outright and there's no debts on the property. And then also on a cash flow basis, now instead of having, just for number's sake, $1,000 a month house payment, you don't have that $1,000 a month house payment, so you're going to cash flow positive by an extra $1,000. And this is like really the number one objective that I want us to hit. I think we can probably do it in 2 years. However, I think it's likely that it won't happen. It may be a little bit longer than that, like somewhere between 3 to 5. I'm going to press for it to be 2, and I'm generally pretty good at when I press for something, I make it happen. But again, I might, in order to make that happen in 2 years, I might have to go and, seek outside investment, or you just do something along those lines, because it's gonna be restricted by cash on hand, right? And then I also have like other investments, like my stock market stuff, that I don't want to take the money out of that. I want to leave that diversified in there. I could cash out everything in the stock market and accomplish that goal this year, but again, I just don't want to. I don't want to mess. I don't want to mess with those things. Like, people who become wealthy, a lot of people and safely do it by just being diversified. Hold money over here, hold money over there, having money coming in from over here. That way, if any one of these things ever fail, you have something else that's still supporting you. Maybe you won't grow as quickly as you was gonna grow, but yeah, like say for instance, like the automotive thing, like we're probably barely breaking even, or if anything, losing money on that. So with the automotive like rental things that we're doing, so like just with that being said, like that's one thing. Okay, we tried it out. We're still trying to dial things in. We're not like shutting it down. We're still operating it, but it's just I don't like vehicles, because vehicles don't appreciate. You can't cash out refi on them. You can't really do anything unless you're gonna do like fix and flips on vehicles, buying vehicles for like $1,000, putting $1,000 worth of work into them, and then being able to sell them for like $5,000, or having a $5,000 equity vehicle. You could do something like that, and then things would kind of work out there. But I don't want to do that. I don't personally want to work on vehicles myself, and yeah, it's not something I want to do at all. So, and I'm also a big long-term holder. I like the long-term hold things that build equity over time, and the vehicles just don't do that. That's why the big thing, we're like really scaling that down. We're scaling it down. We actually just sold one of the vehicles. Oh, and we had a major liability with that one as well. That basically we got delisted. Not we got delisted. One of our vehicles got delisted from the platform. And it was like our highest payment vehicle. It was like a Ford Expedition for like a recall. And they was like, yeah, we're not going to have any information on the recall for like 6 months. And so now here we have a vehicle with a car payment on it that we can't cash flow anything. Zero cash flow off that thing. So like, just being that they can tomorrow flip a switch and say, oh, recall, can't operate that vehicle on our fleet no more. That's just way too much of a liability. No warning, no nothing, no workarounds. So we actually ended up selling that vehicle. Luckily, we sold the vehicle for like the loan amount that we had on it. So we only lost what our down payment amount was, which again was still quite a bit. I think we put $5,000 down on that vehicle. So we basically lost $5,000 on that vehicle. Given like the maintenance we put into it was hardly any, and we did cash flow off of that vehicle, so we probably pretty close to broke even. Maybe since we owned the vehicle, we made like $5,000 off of it. Maybe not even that though. Maybe like $2,000 off of that vehicle. So we're still probably in the net negative like $3,000 or something like that. But yeah, that's just one of the other things that we're doing. Just kind of navigating that, kind of giving you guys like a overview of a lot of the different things that we have going on, and like some of the investment strategies and stuff like that. Again, like if you stayed to like the end of this video here, then definitely drop something down in the comments below on like anything that you're wondering about, right? Anything, because I don't know how exactly to structure these videos. We have so many different things going on. So much of my like investment philosophy are so tied together with other things. Like if the stock market does this, then I do that. You know what I mean? So things are diverse, and I don't just rely on one exact thing, because I'm a being that's trying to re-diversify things. I'm trying to put money in things that has the biggest appreciation with the lowest amount of risk. I'm investing very dynamically that I think a lot of people may not do. A lot of people will only do real estate. A lot of people will only do stocks. A lot of people will only do, you know what I'm saying, like these different things. And so I have a lot of different things going on that we're testing and trying out and doing. So yeah, it's very fluid on how we're executing on that. Oh, but one last thing I'd like to mention is the vehicle thing that we're doing. We're kind of converting that over to being a bit of a bit of for Robotaxi. So we're trying to see if we can get our cash flows right before we make any investment, but we kind of want to buy another Tesla before the incentives end, so that way we can put that on the network. Again, it has that major risk, like I told you, that happened with the Expedition. But we basically kind of want to get another Tesla. If we can get our other Tesla to cash flow positive, then okay, it makes sense. Let's buy another Tesla. At least we'll cash flow slightly positive. And if Robotaxi becomes a thing where we can deploy our Robotaxi to the network, then it comes another cash flowing revenue stream, and then I'm interested in vehicles again. I don't like the equity thing. I don't like how you can't cash out refi and all that. But one thing that's nice about like a vehicle is like you can put like $2,500 down, $5,000 down, and now have a cash flowing asset. Again, the vehicle itself is not necessarily the asset, but the vehicle now cash flows, which then makes it an asset. So the business of Robotaxi is an asset. And so like even if you're only able to make $100 a day or something like that, or even if it's $50 a day, and you can do that every single day, it's what, $1,500 a month, and your payments $800 a month. So, and if you get a good interest rate, you are paying down some of that equity on the vehicle. Again, it's gonna get a lot of miles and stuff on it because it's out on the road every day. But you're gonna have some amount of equity when it's all said and done. Like once that loan's paid off in how many ever years, you're gonna own, maybe a vehicle with 150,000 miles on it, but that vehicle is paid off, still worth $20,000 or something like that, and you cash flowed double what your car payment was every month. So like, again, to crunch some more numbers, at 75, if you did $1,500 a month, and so you profited $700 a month, let's just say 700 times 10, that'd be $7,000. So you need like 8 months for your ROI. That's fucking good. That's a good investment. If you put $5,000 down, even if you profit, that'd be easy numbers. If you put $5,000 down, you cash flowed $500 a month in profit. In 10 months, you would get your money back, and then everything after that would just be pure profit. So getting a 10-month ROI on something is extremely good. That's why that itself is a good business model. And if you can start building out a fleet, so that way whenever it comes available to you, to be able to put your vehicle on the Robotaxi network, yeah, that's a significant amount of money. Or it's a significant amount of money that you can flip a switch on, overnight. Like say for instance, if you're not hardly making any money and you're just basically kind of cash flowing, and then all of a sudden you can put your vehicle on the fleet, and you can start making, let's just go with some decent sized numbers where you had 10 vehicles, and each one of the vehicles is doing $500 a month in profit. That's $5,000 a month in profit every month. It's pretty good money. A lot of people don't even make that much money at a 9-to-5 job, or maybe a lot of people think that's what they make at a 9-to-5 job. And then that doesn't include any other things that you have going on. What happens with that money after you compound it in the stock market? What happens when you invest that money into a property or more vehicles to add to the fleet? Now at $5,000 a month, you can buy another vehicle every single month. That's scaling right there. That's how you scale. Boom, another vehicle, another vehicle, another vehicle, another vehicle. And in 10 months, now you've doubled your fleet and you're making $10,000 a month. See what I'm saying? This is scaling. You got to get to the point where things scale. And yeah, hopefully this was valuable. Hit the subscribe button, hit that like button if it was valuable to you, so that way other people can see it. And we'll catch you on the next one. Peace.